I don't really rule out Bitcoin ever doubling in a year. I mean, it's Bitcoin. But I tend to have more conservative price predictions, which I think there's a good chance we can get back up above 100 this year. Before all this kind of tariff kerfuffle, I would have had kerfuffle. I would have had a higher, I would have had probably a higher price target. If I imagine a scenario that brings us to very high prices this calendar year, it would probably be because some massive liquidity unlock happened. Like, let's say the U.S. bond market broke, the Fed came in and basically did yield curve control, or kind of QE that they don't really want to be doing, or some sort of big treasury operation twist sort of thing. It would probably take something like that combined with some sort of de-escalation of tariffs.
Lyn starts by reaffirming her general bullishness on Bitcoin, stating that she expects Bitcoin to end the year higher than where it stands now. However, she's quick to highlight that there are many variables that could affect this trajectory. In her words, most days where you have a big down day in markets is probably not going to be a good day for Bitcoin. That's because Bitcoin is still viewed as a risk-on asset by institutional pools of capital, and in many ways, that perception hasn't shifted just yet.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
My guess is that we end up higher at the end of the year than we are now, at least. There's a lot of variables that could affect that. So I think that most days where you have a big down day in markets, it's probably not going to be a good day for Bitcoin, just because most pools of capital treat it as a risk-on asset. It's still small, it's still volatile, and a lot of times, especially because it trades 24/7, if people are worried about how things are going to open on Monday, some pools of capital can sell their Bitcoin on a Sunday and prepare, right? So the 24/7 can sometimes, add to its volatile pricing, especially when TradFi markets are freaking out, because we're talking about a sub $2 trillion network compared to this multi-hundred trillion dollar global behemoth of interconnected finance and leverage. So Bitcoin, I think, will get shoved around by volatility. As this kind of settles a little bit, if you do get ongoing capital outflows of the U.S., that actually could be good for Bitcoin. Sometimes people ask, what could make Bitcoin more meaningfully disconnect from the NASDAQ? Well, one is anything that hurts NASDAQ margins, but that does not hurt global liquidity, which should generally be somewhat supportive of Bitcoin, minus certain particularly volatile periods. But then it more structurally impairs the NASDAQ, the S&P 500. We saw similar to this in the closest period to maybe look at or study is the 2003 to 2007 period. That was the prior weaker dollar cycle. There wasn't this kind of mass exodus of capital, but there was around the margins. Capital went to emerging markets, capital went to commodities, capital went to gold, capital went to these other assets. And so US stocks were not really the place to be, and a lot of other assets were. And I think if we encounter a 5-year period like that again, that could be a period where Bitcoin does pretty well, even as the stock market, the US stock market, doesn't do particularly well. So that's kind of how I view it. I think volatile but favorable.
Well, we started the year around 93, 94,000. Are we still in a bull run, Lyn?
Short answer is I think longer term, yeah. I think that Bitcoiners got very attached to cycles. And I think especially as the asset gets larger, those cycles become less clear. Anytime a lot of market participants think they know how something works is when it tends to change. So just when all TradFi market participants were like, well, bonds always go up when stocks go down. As soon as they all know that, that's when it stops happening, because it's already fully positioned for, and then it's not going to happen. And so I think that basically everyone's seen the Bitcoin cycle so many times, they expect there to be a cycle, and cycles can change. And so I think it's less about the halving cycle. It's more about the liquidity cycle, but liquidity is complex in this environment. We've at least taken off some tail risks of politics for the next few years. So Bitcoin has always had kind of this embedded probability of what if the US takes its gloves off and just goes after Bitcoin really hard? right? Because I would certainly, tell every major financial institution in the U.S. that you can't custody your own Bitcoin. Kind of go after it. That's at least off the table for a while. So I think that a lot of the fundamentals look pretty good at the current time. So I expect pretty good performance over the next year or two. But it is subject to not having like a 30% market crash or things like that could, temporarily push us lower that we'd have to then rebuild from. And I think it was at the time of the conference, it was like probably the upper 60s, 60 some thousand. And I was like, well, it wouldn't be my base case, but Bitcoin can do Bitcoin things. And it did. It touched 100K by in a fairly short period of time. It jumped from the 60s all the way up to 100K. So I don't really rule out Bitcoin ever doubling in a year. I mean, it's Bitcoin. But I tend to have more conservative price predictions, which I think there's a good chance we can get back up above 100 this year. Before all this kind of tariff kerfuffle, I would have kerfuffle. I would have had a higher I would have had probably a higher price target. If I imagine a scenario that brings us to very high prices this calendar year, it would probably be because some massive liquidity unlock happened. Like, let's say the U.S. bond market broke, the Fed came in and like basically did yield curve control or like, kind of QE that they don't really want to be doing, or some sort of big treasury operation twist sort of thing. It would probably take something like that combined with some sort of like de-escalation of tariffs. So I never really rule out what Bitcoin's doing. I look at a couple of things. One is I think liquidity is probably going to be somewhat favorable for the rest of the year. And two, if you look at certain valuation metrics, I like to look at the market cap to realized cap ratio, which is market capitalization compared to the average on-chain cost basis. And this current consolidation has taken off a lot of the hype around it. So if you look at the prior consolidation, so Bitcoin reached 73,000 in March 2024. That ratio got a little bit elevated. So it wasn't elevated to the point of like prior like multi-year tops, but it was a little bit heated. And so after about a 7-month consolidation, it pretty much worked off all of that excessive valuation, that excessive hype, kind of allowed the market to consolidate. Then when it jumped to like, 108K, it kind of reached similar frothy levels. And so the fact that we've been consolidating for several months, not particularly surprising. I think we worked off a lot of that valuation already. So I think we're at a pretty strong foundation to at least start building from, especially once we get past maybe near-term stock market shocks and things like that.
Lyn also touches on one of Bitcoin's most fascinating future use cases, interfacing with AI agents. She explains that AIs often struggle to access traditional banking or credit rails, but spinning up a Bitcoin wallet is much easier. AI services are hardware-intensive and incur real-world costs, making them particularly sensitive to issues like chargebacks or fraud, which plague credit card systems. Because Bitcoin payments can be final, they're naturally well-suited for microtransactions and high-assurance digital settlements in an AI-driven future.
Right now, in the existing framework, gold is the primary neutral reserve asset that central banks already own. They already know how to buy. So that gets kind of the initial benefit. Bitcoin is the up-and-comer. So as long as it continues to stay decentralized and secure, I think it'll continue to grow in size. It has the benefit that it has its own settlement network attached to it. It's kind of half the point. Whereas the reason gold can't kind of by itself be the best global reserve asset is because then you need this like layer of credit on top of it. Whereas Bitcoin can function on its own. In addition, when we've seen these other countries try to go around the dollar, they're always trying to build these like systems to interface with each other. So all these like closed systems, trying to figure out how to do cross-border trade, while there's this really powerful open source solution kind of staring them in the face. Now, it is understandable that they've not rushed to it because, using the Bitcoin network means owning volatile Bitcoin. It's also still fairly small compared to the scale that the world would need for something like this. So there's some degree of career risk of being early, for example, but it is kind of reaching the scale where I think that countries will increasingly take it seriously. And so both as a neutral reserve asset and as a global settlement network, that's very powerful. In addition, all the existing things already has. Basically, if you're in a place that's authoritarian, individuals can benefit from Bitcoin as well, rather than just countries at the sovereign level. So the full stack and down, I think is pretty powerful. And then in addition, we talked about AI. It's hard for AI to get bank accounts It's easier for them to spin up a wallet. And so I think that it makes sense that Bitcoin is a powerful tool for AI agents in the future as well, microtransactions, things like that. In addition, there's also like a lot of kind of existing software. When they face things like credit card fraud, where you pay for their services and then cancel, get your money back, they didn't really lose much by giving you that service temporarily because it's a high margin business. Whereas AI services are pretty hardware based. They actually incurred a cost. And so they have a higher stakes in avoiding things like chargebacks and fraud and things like that. And one of the advantages that Bitcoin is at least done certain ways, it's final, which matters more for certain types of payments than others. So I think that Bitcoin fits in multiple ways into this vision of the future. People often question, is the global reserve currency good for America? With the kind of assumption that the answer is yes. But like any country, especially one as big and dynamic as America, there's not just one America. It's a big mix of a lot of different things going on together that happen to be in one political entity. And so that status basically empowers certain parts of the economy, certain people in the economy, and then it hurts others. And so, for example, if you're in Washington, D.C., and you want to be able to sanction almost anyone in the world, it's nice that everyone's using your ledger. It makes it harder for any entity to go around it. Not impossible, but your sanctions are rather powerful compared to if Canada's sanctioning you, for example. You get a lot of leverage that you can basically pressure other countries with. You have the rest of the world financing part of your deficits because they have this kind of structural need for assets. It's generally good for the stock market because all this capital, what countries do with it, there's often this thing that people say, well, we're sending them pieces of paper and they're sending us goods and services, which is true, but then there's one more step. With those pieces of paper, they go and buy our financial assets. So they buy our stocks, they lend to our corporations, they buy our private equity, they buy some of our real estate. So what we're doing is we're selling portions of our appreciating assets to the rest of the world, and we're acquiring some of their depreciating assets, goods and services, which are useful, but they're different than appreciating assets. So if you're in New York, if you're in the dollar export business, basically, which is a combination of Washington and New York, that's great. If you're in a high margin industry like tech, healthcare, places like that, you're maybe not super benefiting from it, but you're not really harmed by it either. You're not really, you get a lot of the privileges of having a strong dollar without a lot of the downsides.
Lyn challenges the assumption that the U.S. dollar's reserve currency status is universally good for America. She notes that the benefits are highly unevenly distributed, favoring Washington, D.C., Wall Street, and high-margin sectors, while harming U.S. manufacturing and the working class. Foreign countries accumulate dollars by sending the U.S. goods and services, but then use those dollars to buy American financial assets, stocks, bonds, real estate, meaning the U.S. trades real appreciating assets for foreign depreciating goods. That dynamic concentrates wealth and power in sectors that benefit from strong dollar policies while exporting the downsides to others in the domestic economy. Please like and subscribe.